At 8:30 a.m. Eastern Time this morning, Tuesday, April 21st, 2026, two critical economic data releases hit simultaneously. US March retail sales and Canada March CPI. Every American investor is watching the retail sales number. Almost nobody is watching the Canadian inflation data. That is a catastrophic mistake. Because Canada's CPI is not just a neighboring country's economic statistic, it is a 4 to 6 week forward preview of where US inflation is heading. And what drops at 8:30 a.m. this morning is going to tell you more about the Federal Reserve's policy path, about silver's next move, and about the dollar's trajectory than anything Kevin Warsh says in his confirmation hearing 2 hours later. Silver is at $80.28 this morning. The Canadian data that releases in the next few hours will tell you whether that number is heading to $90 or back to $72. And I am going to show you exactly how to read it, using data points that no other silver channel is tracking. Let me start with the economic relationship that most American investors do not understand, and that creates the predictive power of Canadian data. Canada is the United States' single largest trading partner. Not China, not Mexico, Canada. In 2025, bilateral trade between the US and Canada totaled approximately $718 billion. That is $197 billion in goods and services crossing the border every single day. When two economies are that deeply integrated through trade, their inflation cycles become synchronized. But here is the critical asymmetry that creates the leading indicator effect. Canada is a net exporter of oil. The United States is a net importer. When global oil prices spike, Canada experiences the inflation impact differently and faster than the US does. Canadian oil producers in Alberta benefit from higher prices. That creates immediate income growth in the Canadian energy sector. Those workers spend. Prices rise. Canadian CPI reflects oil-driven inflation in its purest, most direct form within 30 to 45 days. The United States, by contrast, uses strategic petroleum reserve releases, refinery subsidies, state-level gas tax holidays, and other policy tools to buffer consumers from immediate oil price shocks. US CPI reflects oil-driven inflation on a delayed and dampened basis, typically 60 to 90 days after the initial oil price move. The result is that Canadian CPI consistently leads US CPI by approximately 4 to 6 weeks, when oil is the primary inflation driver. And right now, with Brent crude at $95 and the Strait of Hormuz still effectively closed, oil is absolutely the primary driver. Here is the Bank of Canada policy position that sets up today's data as a critical binary event. The Bank of Canada held its overnight rate at 2.75% at its most recent meeting. That is 75 to 100 basis points below the Federal Reserve's current 350 to 375% range. The market consensus heading into today's CPI release was that the BOC would cut rates at its June meeting, bringing Canadian rates down to 250%, provided inflation continued to ease. But the Iran war changed the inflation trajectory. Oil has been trading at $90 to $90 Brent throughout March. Canadian gasoline prices are directly indexed to Brent crude. Transportation costs for Canadian retailers, many of whom import goods from Asia through Pacific ports, have been elevated by the war-driven rerouting of shipping lanes. If today's Canadian CPI prints above 2.5%, which is the top of the Bank of Canada's target band, the June rate cut evaporates. The BOC holds at 2.75%. And here's where the US investor warning comes in. If Canada's inflation is proving stickier than expected, despite lower interest rates than the US, despite a smaller economy, despite less fiscal stimulus, then US inflation with higher rates, larger deficits, and more monetary stimulus is going to be even stickier. Canada's CPI is the stress test. If Canada cannot get inflation below 2.5%, the United States has no chance of hitting the Fed's 2% target. Here's the currency mechanism that makes this directly relevant to every silver stacker in North America, American or Canadian. The current USD-CAD exchange rate is approximately 1.39. That means $1 buys 1.39 Canadian dollars. For American investors, this seems irrelevant. You buy silver in USD. Who cares about CAD? But here's the mechanism that connects the two. If today's Canadian CPI prints hot and eliminates the June BOC rate cut, the Canadian dollar weakens. Rate differentials drive currency values. If the Fed holds at 350 to 3.75%, while the BOC holds at 2.75%, that 75 to 100 basis point spread favors the US dollar. Capital flows to the higher yield, USD strengthens, CAD weakens. At USD CAD of 1.42, which is where the currency pair trades if the BOC holds and the Fed holds, silver at $80 USD costs a Canadian buyer $113.60 per ounce instead of today's $111.20. That is $2.40 more per ounce with zero change in the USD spot price. Now here is why American investors should care. Canada is one of the world's top silver producers. First Majestic Silver, Pan American Silver, and dozens of mid-tier miners operate in Canada and Mexico. When the Canadian dollar weakens, those miners' costs denominated in CAD stay relatively stable, but their revenue in USD increases. Profit margins expand. That dynamic has historically driven Canadian silver mining stocks higher during periods of CAD weakness. And when mining stocks rally, they front-run the spot silver price by 4 to 8 weeks. The currency signal from today's Canadian CPI is an early warning system for where spot silver goes in June and July. Here is the Sprott PSLV data that makes Canadian inflation directly actionable for American stackers. The Sprott Physical Silver Trust, ticker PSLV, is a Toronto Stock Exchange-listed fund that holds 100% allocated physical silver in Canadian vaults. Unlike SLV, which holds silver in London LBMA vaults and can theoretically cash settle, PSLV investors can redeem for actual physical delivery. PSLV's net asset value is calculated in Canadian dollars and then converted to USD for the NYSE ARCA listing. When the Canadian dollar weakens, PSLV's NAV in CAD stays relatively stable because the silver it holds is priced globally in USD. But the USD share price reflects both the silver price movement and the currency translation effect. Here's the specific trade setup that today's CPI creates. If Canadian CPI prints hot, CAD weakens, and PSLV's USD-denominated shares become cheaper relative to the value of the silver they represent. That creates a technical discount to NAV that sophisticated traders exploit by buying PSLV shares, holding through the currency normalization and capturing the spread when it closes. For American investors, a hot Canadian CPI print that weakens CAD is a buy signal for PSLV specifically because you're getting both silver exposure and a currency arbitrage embedded in the same trade. Let me show you the First Majestic bellwether signal that Canadian data activates. First Majestic Silver, ticker AG on the NYSE and FR on the Toronto Stock Exchange, is Canada's flagship primary silver miner. It operates mines in Mexico and Nevada, producing approximately 25 to 30 million silver equivalent ounces per year. First Majestic is directly exposed to both the Canadian dollar and the Mexican peso. When CAD weakens, First Majestic's Toronto-listed shares denominated in CAD become more attractive relative to its NYSE listing. Arbitrage traders buy the cheaper listing and sell the expensive one, which typically causes both to converge higher. But here's the specific mechanism for today. If Canadian CPI prints hot and CAD weakens, First Majestic's costs in Canadian dollar terms stay relatively flat, while its revenue in US dollars increases because silver is globally priced in USD. That margin expansion shows up in earnings guidance, which shows up in analyst upgrades, which shows up in the stock price 3 to 6 weeks before it shows up in spot silver. First Majestic CEO Keith Neumeyer has been one of the most vocal advocates for physical silver delivery reform and has publicly discussed taking COMEX delivery rather than rolling contracts. If Neumeyer sees margin expansion from currency effects and simultaneously sees COMEX delivery stress building, the probability of First Majestic standing for delivery increases dramatically. Watch First Majestic's stock reaction to today's Canadian CPI. If FR2 rallies while spot silver is flat or down, that is the early warning signal that smart money is positioning for a physical squeeze 4 to 6 weeks out. Here's the cross-border premium arbitrage that Canadian inflation data unlocks for stackers who understand it. Royal Canadian Mint Silver Maples are currently trading at approximately $116 to $120 per ounce at Canadian dealers. At today's exchange rate of USD CAD 1.39, that converts to approximately $83.45 to $86.33 USD per ounce. American Silver Eagles are trading at $80.49 at APMEX. Generic rounds at SD Bullion are $85.999. Here's the arbitrage. If Canadian CPI prints soft below 2.3% and the Bank of Canada cut expectations return, CAD strengthens. USD CAD drops to 1.36. At that exchange rate, $116 maples convert to $85.29 USD. You just saved $3.20 per ounce by buying Canadian product with a stronger Canadian dollar. But if Canadian CPI prints hot above 2.7% and CAD weakens to 1.42, those same $116 maples now cost $80.69 USD. You save $6.80 per ounce. The arbitrage works both directions depending on the data, but the key is that American stackers who understand the currency mechanism can time their Canadian maple purchases based on Canadian CPI prints and save 3 to 8% on acquisition cost with zero change in the metal's intrinsic value. Here is the oil exporter inflation dynamic that makes Canadian data structurally different and more predictive. Canada produces approximately 5.5 million barrels of oil per day, primarily from Alberta oil sands. Canada consumes approximately 2.4 million barrels per day domestically. That makes Canada a net exporter of roughly 3.1 million barrels per day. When oil prices spike from $60 to $95 Brent, as they have since the Iran war began, Canadian oil producers see massive revenue increases. Those revenues get distributed to workers, shareholders, and suppliers. That new income enters the Canadian economy within weeks and drives consumption, which drives prices, which shows up in CPI. The United States produces approximately 13 million barrels per day and consumes approximately 20 million barrels per day. The U.S. is a net importer. When oil spikes, U.S. consumers pay more at the pump, U.S. airlines pay more for jet fuel, U.S. manufacturers pay more for energy inputs. That is inflation through cost push. And it takes longer to show up in CPI because businesses try to absorb cost increases before passing them to consumers. The result is that Canada's CPI reflects oil price shocks 30 to 45 days faster than U.S. CPI. If Canadian March CPI shows oil-driven inflation is proving persistent, U.S. April CPI, which releases in early May, will show the same pattern 4 to 6 weeks later. The Canadian data is not just correlated with U.S. data, it is predictive. Let me give you the 3 scenario breakdowns for today's 8:30 a.m. Canadian CPI release and what each means for silver. Scenario 1. Canadian CPI prints below 2.3%. This is the dovish surprise. Inflation is easing despite oil at $95. The Bank of Canada cut in June is back on the table. CAD strengthens to 1.36. Silver faces short-term pressure as the inflation is under control narrative gains credibility. But this scenario is low probability, approximately 20%, because oil was elevated throughout March and gasoline prices are directly indexed. Scenario 2. Canadian CPI prints between 2.3 and 2.7% in line with expectations. The BOC remains data dependent. CAD stays near 1.39. Silver trades sideways in the 78 Autos to $82 range. This is the base case, approximately 50% probability. The June BOC decision remains uncertain, and markets wait for April data before making a strong directional bet. Scenario 3. Canadian CPI prints above 2.7%. This is the hawkish shock. Oil-driven inflation is proving stickier than the BOC anticipated. The June cut is off the table. CAD weakens to 1.42 or higher, and here's the silver implication. If Canada, with lower rates, smaller deficits, and less monetary stimulus cannot get inflation under control, the Fed's 2% target is completely unachievable. Rate cut expectations for the U.S. collapse. But simultaneously, the realization that inflation is structural rather than transient drives safe haven demand for silver. This scenario is approximately 30% probability and is the most bullish for silver medium term. Here is the retail sales connection that makes today's dual 8:30 a.m. release the most important data drop of the week. U.S. March. Retail sales releases simultaneously with Canadian CPI. The consensus expects plus 1.4% month over month, boosted by tax refunds. If U.S. retail sales beat expectations while Canadian CPI prints hot, you have confirmation of the worst-case stagflation setup. Strong spending in the U.S. means the Fed cannot cut rates to support growth without risking further inflation acceleration. Hot inflation in Canada means the oil-driven price pressures are not transient and will show up in U.S. data within 4 to 6 weeks. The combination of strong U.S. retail sales and hot Canadian CPI creates the exact policy trap that drove silver from $1.50 to $49.45 during the 1970s stagflation. The Fed cannot cut to help growth. The Fed cannot hike enough to kill inflation without destroying the economy. Real rates go negative, and silver becomes the only liquid asset that preserves purchasing power. Watch for the dual print at 8:30 a.m. If retail sales beat and Canadian CPI is hot, that is the stagflation confirmation signal. Here is the Mexico dimension that connects to Canadian data through USMCA trade rules. The United States-Mexico-Canada Agreement governs trade relationships between all 3 countries. Under USMCA rules, changes to tariffs or trade policy affecting one member must be reviewed in the context of impacts on all 3. The Section 301 investigation into Mexico's silver exports has a May 5th public hearing. If tariffs are applied to Mexican silver, Canadian silver miners become more competitive by default because their product enters the U.S. tariff-free under USMCA. First Majestic, which operates in both Mexico and has Canadian headquarters, could potentially restructure its exports to route Mexican-mined silver through Canadian processing facilities to qualify for USMCA tariff exemption. If today's Canadian CPI shows that Canada's economy is under less inflation stress than expected, it strengthens Canada's negotiating position in any future trade discussions. A stronger Canada economically means stronger protection for Canadian miners under USMCA, which means a more resilient supply chain for US dealers sourcing from Canada. The Canadian CPI is not just an inflation print, it is a trade policy signal. Here's the final data point that makes today's Canadian release the canary in the coal mine for US silver investors. In every major inflation cycle since the 1970s, Canada's CPI peak has preceded the US CPI peak by an average of 6.3 weeks. In the 2021-2022 inflation surge, Canadian CPI peaked in June 2022 at 8.1%. US CPI peaked in July 2022 at 9.1%, a 5-week lag. If Canadian CPI has peaked and is declining, US CPI will follow 4 to 6 weeks later. If Canadian CPI is reaccelerating or proving sticky, US CPI will do the same on a lag. Today's Canadian March CPI print will tell you where US April and May CPI are going before the data is even collected. You get a 4 to 6 week forward look at the Fed's policy problem. And when you know where the Fed's policy problem is going 6 weeks before the Fed does, you can position in silver before the market fully prices in the implications. Tuesday, April 21st, 2026, 8:30 a.m. Eastern. Canada March CPI releases alongside US retail sales. Bank of Canada at 2.75% with a June cut on the table. USD CAD at 1.39. Silver at $80.28. First majestic position to benefit from CAD weakness. PSLV offering currency arbitrage embedded in silver exposure. Canada's oil exporter status making its CPI data 4 to 6 weeks predictive of US inflation. Section 301 Mexico hearing in 14 days, making Canadian supply chains more valuable. And every historical cycle showing Canadian CPI leads US CPI by 6 weeks. The warning is not in the US data. The warning is in what Canada tells you about where the US is heading before anyone else sees it. This is stacker intelligence. Do your own research. This is education only. And watch that 8:30 a.m. print like your silver position depends on it, because it does.